I quite like the concept from an efficiency perspective of, wouldn't it be so much easier if I could go to a client and I could go, hey, look, can I have all the stuff that I need to make sure your finances are in order or something else? I mean, to be fair, I might not need to because potentially a smart contract could do that. But you've got layers, like, and I don't know whether that needs to be completely transparent or, you've got a hybrid model here where there's some privacy and some transparency in terms of what we're doing. But the idea here generally just of immutable financial transactions that are interacting with smart contracts and various sorts of things that are happening. I really like that because AI coming along and categorizing and reconciling and all of these sort of things, where if things could be on chain and they could be immediately tagged and categorized and accounted for in real time, you could genuinely have real time financial information.
Welcome to Blockchain Beyond the Hype, the podcast that cuts through the noise to deliver practical insights into how blockchain is transforming industries today. Brought to you by Kumo, a blockchain partner that is dedicated to bridging the gap between existing infrastructure and launching real-life blockchain solutions. Together, we'll explore what's possible for the future and take a look at industries where blockchain can have the biggest impact, from travel and hospitality to real estate, renewable energy, and even diamonds. Join us as we uncover the way blockchain is disrupting industries beyond the hype.
All right, well, it's a pleasure to be with you, Ben. You come from a very, very interesting area of the blockchain market, I guess, in the fact that you work with, regulations, compliance, and also accounting. It's a very interesting area because I think a lot of businesses kind of forget that it's such a big part of their strategy. And so from my side, as we are also building a business in the blockchain space as well, this is not just a conversation to interview you, but also, to learn some stuff as well.
Yeah, sure.
But I understand that you started in chemistry and then you went to accounting, and now you're in the blockchain space. So it'd be great to get like a kind of a roadmap of how you ended up from there all the way over there.
It's an interesting one. I've always been interested in technology. My dad worked for an IT firm when I was growing up, so he was always bringing back computers. We went through. It was great. I saw the advancement of technology all the way from sort of the 086, 286, 386, 486 Pentium, all these progressions, and I was always really interested in how they worked. I was always sort of taking them apart, putting them together, trying to build my own PCs. But I left school to do chemistry. I really enjoyed sort of the maths behind chemistry. I'm not sure if that's cool to say. It's okay to say that, I think, as a 41-year-old now, but at the time, I'm not sure how cool that might have been. But went to do chemistry, really enjoyed it. But then sadly, you come out of university, and whilst I would have loved to have continued working in a lab, the finance side of the job market was slightly more appealing from a remuneration perspective. And then I became a chartered accountant and a chartered tax advisor, but I've always still maintained that interest in technology. So when blockchain and cryptocurrencies first started developing, I would say my first exposure was probably around sort of 2013, 2014. And I think what's happened for me is there's just been a beautiful blend of something that I'm incredibly interested in at a fundamental level that has combined with what I have ended up doing as work. I always say, I'm not sure anyone ever wants to become an accountant. It's what we sort of fall into. But thankfully, I've had this opportunity to go and actually pursue an industry which I'm very passionate about, but also use the skills that I've developed over time as an accountant and a tax advisor, because I think it's very rare that you sort of get a new asset class, you get something completely different that absolutely shakes what you think about what you do. I love problem solving. I love anything that's new and disruptive. So I'm very lucky to be working within this sector and working with lots of businesses and lots of individuals that are navigating their forward in this space as well.
You said something quite interesting about it's very unoften you see two different asset classes, or a new asset class rather, introduced into the market. Can you give like some kind of conceptual idea of how a crypto digital asset kind of varies from or blockchain digital asset as well, varies from, a traditional either physical real world or financial asset?
Of course. Do you mean from an accounting perspective, as in how we approach it?
Yeah. I mean, however you feel.
Of course. So a lot of this, there was lots of speculation in the early days as to what what is crypto from a fundamental perspective? We've obviously got to the point now where it is a form of property. But things like buildings or commodities, we've been dealing with for years and years and years and years. So the accounting rules and tax position around these are very well structured. So when I mentioned, obviously, we've got something new that we have to deal with, it's interesting, and the clue there is obviously in the term there. These digital assets, they are an asset, they are a form of property, but we use them like money. And
Mhm.
whilst money is obviously an asset on the balance sheet, we don't account for money in the same way. It's fluid, it's liquid, it's we use money obviously to undertake commerce and everything else. So we're kind of used to how we use money, but now we have an asset that we're using like money. And unfortunately, that's where all these friction points then start coming into place, because you've got rules around the acquisition and disposal of properties from a tax perspective. I sell, obviously not if I sell my own home, I'm not subject to a tax charge if I've lived in it, but if I sold a second home, then I'm subject to tax because it's an asset that I have that I'm selling. It's the same with digital assets. So we are using something like money. So we're using it often, and I'm talking more here from a business perspective rather than obviously like an individual investor, but we're using it to undertake commerce. We are using it to receive payment for goods and services we might be doing, or tokens that we are selling. And we're also using it to pay contractors and various other people out there in the marketplace. So we're using it. If anything, we're almost going back to the time, I'd be going, hey, look, I really like your cow. Would you like these shells for your cow? So
Bartering, yeah.
we're bartering with
Yeah.
assets. And what we don't have, because obviously we've moved on from those times, is legislation or accounting framework that specifically deals with us undertaking transactions in that manner. So that's why, for me, it was really fascinating, because one, you've got to really understand what it is that you're dealing with. Two, we can't just say, oh, cool, all digital assets are the same, right? Because fundamentally they're not. We know that we've got so many different types of tokens, whether that's exchange tokens, security tokens, governance tokens, all having different characteristics, and all then having an effect on how we might account for them, or what effects we might have when we acquire or dispose of them. We still, to this date, right, and where are we now, like 15 years on, have no specific in tax legislation or accounting standards to deal with an asset class. And that still blows my mind, right? Because I'm sure most people in this space feel like they've been here for a long time. I certainly feel like they've been here for a long time. And I know crypto years are very much like dog years, right? I think 1 year in crypto feels like
Yeah.
7 years in the real world. Like I'm sure I had hair before I got into crypto or something, it feels like a long time. So it feels, and don't get me wrong, right? Obviously here in the West, a lot of our success is built on the infrastructure that we have. And it takes a long time to introduce new legislation and new frameworks. But this doesn't feel new anymore. This feels like this has been around. It's proven that it's been around. It's proven that it's here longer term. But yet we still don't have the necessary framework, in my personal opinion, to really help scale adoption, as well as help businesses in the space as well.
I mean, you don't just work the UK market, right? You
No,
are
no.
you work at multiple markets and stuff. How do you see the difference in the classing of these digital assets? Looking at maybe North America, UK, and Europe, because obviously we've had a lot of stuff with Mika recently as well.
Yeah, of course.
So, I mean, how would you see the variations between those three?
I think when it comes down to actually the nuances of how different tokens work, there is some similarities throughout the jurisdictions, which obviously makes life easier, albeit different. Every jurisdiction has, potentially their own accounting policies, their generally accepted accounting policies. We obviously have the international financial reporting standards as well, but also there's local tax legislation to deal with as well. So in a way, it all becomes quite competitive, and we've seen that within the market. We've seen businesses, because this is global, people don't have to necessarily be situated in a certain jurisdiction. So we see a lot of mobility of individuals and businesses across the globe due to this competitiveness. Obviously the UAE is very much a hotspot at the moment, particularly
For
because of the
scams too.
for scams. Yeah, absolutely, absolutely. But there's an allure there because there's the community there, and obviously they've got targets, to build their population, and tech is a great place to focus on that and bring in talent. And I think we're actually leaking, certainly from the UK, we're leaking talent. It is all competitive, and effectively tax legislation and regulations drive that competition. So it's an interesting and ever-changing world, both from a tax well, mainly from a tax perspective, because you will certainly have structures that have been established for a very long period of time that are having to look at restructuring as a result of movements in the market, or where might be attractive, or there might be changes in tax legislation globally that then affect where the most optimum place may be to undertake the business.
I remember like in the quite early days, like 2016, 2017, London and Zurich were quite big hubs for
Yeah.
certainly the knowledge creation, transfer and stuff. There were quite a few companies that I met. I actually met the CEO of Binance
Okay.
back in 2016, I think it was, in Berkeley House.
Oh, right.
And also quite a few other people, the guys who started USDT. And so it was quite active. I wasn't going to Zurich so much. But then you also saw this increase of other countries. So I think it was the Maltese Prime Minister, right?
Yeah.
He came
Yeah.
out and he tried to invite every crypto company in Europe to Malta, and there's still loads there.
There is. Yeah.
And then there was Slovenia. Estonia was also quite big in the crypto sector. I think the other one was Gibraltar, if I'm not mistaken.
Yeah, there's a lot of businesses up based out of Gibraltar. Yeah,
Yeah.
they did quite a lot to entice people over there. In all those countries you've mentioned there, it's interesting about the tax rate. Like, I think it was Slovenia that introduced a 5% flat rate of tax on crypto. And some of those Eastern European countries have very good R&D tax credit regimes as well for development. So again, we come back to that competitiveness of the early adopters, if you will, from a jurisdiction perspective, that were like, hey, look, yeah, we'll pave the framework, but there's incentives not only from the business but from an individual perspective as well.
How do you feel the HMRC in the UK sees R&D tax credits on blockchain projects versus crypto projects?
Sure, and that it's an interesting distinction. I think it's still a tough space. So you can still claim R&D. The notion behind R&D, for anyone that doesn't know more about this particular credit, is, you have to be doing something new in a field of science. It needs to be sort of innovative, and you need to be able to prove that it is new. No one else has done it before. And for a lot of, let's say, crypto projects, if we were around the clock 3 years ago, is your NFT project really a new advancement in science and technology? Probably not. It's just another 10,000 PFP collection, right? And HMRC are certainly clamping down. R&D has been an area where there's been a lot of fraudulent claims made, in terms of projects that aren't necessarily doing something particularly new. Like, one of the key features actually of a successful R&D claim is the ability to show that you failed at doing something. Because obviously the more times you fail at doing something, you can prove, well, actually, look, we got to X point, this didn't work, so actually we went on and did X, Y, Z to get to where we needed to be. Obviously, within this space, there's lots of new people doing lots of new things. And I think where you have split them between blockchain and crypto, I think there's probably a lot of scope, let's say, on the blockchain side of things, where we're building infrastructure, where we are genuinely implementing new advancements, whatever they may be. That side of things, I would say there's a lot more scope for an R&D claim. On the crypto side of things, it's potentially harder. Again, it depends what your project is doing. If you're building a new liquid staking platform, okay, but why might that be different from all the ones that already exist? Even though it might be on a new chain, fundamentally, what does that look like?
I do remember sitting in a talk back in 2017 where we had this HMRC guy come down, and he was talking about the way they were kind of designing their policies back in, like, say, 2017, when everything was still quite fresh. It was right in that ICO craze as well. To now, I mean, what do you think is the evolution that you've seen from the HMRC, and do you think they are becoming more strict on how they're approaching this? And should people be aware if they are holding any decent amount of crypto assets or something of that sort?
Absolutely. Okay, let me take you on I'm not a historian, but I'm going to take you on a brief history. If there's a bit of history I know, it's HMRC and crypto, right?
Just so we're clear, by the way, this question is an answer that I'm going to send to my brother.
Okay, fantastic. So obviously, in 2014, right, we got a VAT briefing about cryptocurrencies. It's one of the first things that HMRC sort of published about crypto assets. And unfortunately, to their detriment, they made a statement which basically alluded to the potential that investing in cryptocurrencies may be so speculative that it would be akin to gambling. And of course, gambling wins are not taxable. So I think everyone went, great, yes, this is so speculative. Everything that I'm doing is not taxable because it's basically gambling. which sadly is not the case. It was just, dare I say, a poor choice of words to put into that briefing note. And as you quite rightly said in 2017, then the ICO period, obviously Bitcoin surging, HMRC are clever. I'll give them that. They will see more hits on their website and they will look at like Google Analytics and they will suddenly see everyone Googling, do I have to pay tax on crypto? Or going to HMRC and searching for crypto. And they'll suddenly go, oh, right, hang on, there's suddenly a peak here. Oh, and look, Bitcoin's peaked. And actually, we started to see the first inquiries that I've ever seen specifically into crypto in 2018. And that's when they published better guidance as to how crypto is considered and how it would be taxed effectively as an asset that is subject to capital gains tax here in the UK, which caught a lot of people out. To date, we've seen HMRC send inquiries out to individuals where they have some information that they've obviously been investing or trading in crypto, or they've tried to do a tax return themselves and they've put it on there and they kind of question whether that's right or not. Interestingly, HMRC do put reliance on the use of tax calculators, things like Coinly, Recap, Crypto Tax Calculator, all these things where they know that they apply the UK rules properly. I think the issue there for UK taxpayers is, one, understanding actually the limitations of the software, and making sure the data is right, because dare I say, it would be very easy to go online, link all your wallets, all exchange data, get all the APIs sorted, or upload all the CSVs. It spits out a number. I put that number on my tax return. Happy days. HMRC are satisfied that I've used a piece of software that they know calculates the tax rules properly. But no one's checking that data. Like unless it's high risk, HMRC aren't going to go through, let's say, 200 pages of someone who's done 20,000 transactions in a year to establish whether all of those transactions are right. And these softwares are very good at doing the heavy lifting. And case in point, we had, an individual that was incredibly successful come to us, but by going through that data line by line, and yes, there are people out there, thankfully, within my team that actually enjoy doing this, we actually saved him £800,000 of tax he'd overpaid in the previous year because that data was wrong. So there's two sides, right? There's a side whereby we go, right, okay, we know if you're doing it and you're using correct tax software, HMRC are generally happy, but there's also a risk as to whether you are overpaying as a result of the data that you're actually submitting to HMRC.
So let's ask that question about the tokenization of a corporate structure. I think it's a really interesting subject. It's something we've definitely looked at ourselves as well, conceptually. What are your perspectives on it? Have you seen it before? Have you done it before?
Yeah, sure. So, and speaking completely honestly, we've had a lot of conversations about it. It's not something that we've yet to enact or facilitate here in the UK. Simply because, again, there's a theme throughout here in terms of our institutions and infrastructure. I love the concept of tokenized equity, purely from sort of faster issuance, fractional ownership, creating that liquidity, global transferability. Like, again, we're talking about freedom of financial markets and the ability for everyone to get involved. So conceptually, I love the idea. The difficulties that we've had in the UK when it comes to tokenization of securities is the inability to have real-time cap tables. We can't have that at Companies House. There are also various tax issues around, right, who's actually an owner, who's just a participator, a little bit like in a DAO, right? What are the tax consequences of, and sorry to bring this back to tax, but what actually then happens when I do sell that? Are there any implications for me as an individual, and how does that company then know that I've sold those tokens, and what effect, if any, does that have on the company? So there's quite a lot to that question. I mean, conceptually, yep, huge fan. Always been really interested in DAOs, love the governance model, love everyone being able to have a say, love everyone being able to have a vote. I just think there's too much friction within legacy concepts here, right? You've got new models, old rules. Certainly here for the UK, to be able to facilitate that, we would need to overhaul so many things, I think, to actually make that a reality, to make it actually function as we would want it to. I've seen a lot of people are doing this in other jurisdictions. I've actually seen, people putting property inside a business in Singapore and then tokenizing those shares, right? Love it. I before being in crypto, I was a tax advisor within the property industry. And when crowdfunding became very trendy, I was thinking, I just done a piece of due diligence for a foreign investor who bought a piece of commercial property in London for 200 million. And I was thinking, God, if I could just own like 1 square foot of that would that would be amazing. Right? That's probably what I could afford on my accounting salary back then, perhaps. But I would happily ride how well that property is going to increase in value over the next 10 years, right? So how do I then go about crowdfunding property purchase? And I looked into it. Unfortunately, the cost even then was still prohibitive. But that idea of, right, everyone can just have a piece of something and share in that value and future value. Yeah, absolutely love that. And I do hope we can get to a point where we can do this from a governance perspective, as well as, let's call it a security perspective, that concept of genuinely tokenizing equity, which also would bring with it future rewards based on the business's growth. Yeah, very, very keen. Sadly, the cynic, I feel so much would have to change here domestically in the UK for that to happen.
So there's two different things that you touched on. One was, fractionalized ownership of assets, like real world assets. And then there was fractionalized ownership of a company in the form of DAO. Now, one I agree with, one I think is a scam.
Oh,
Which one do you think it is? And which way around do you think it is?
interesting. So DAOs, are you not a fan of DAOs?
Well, because the whole concept of a DAO is to sell conceptually the idea that you are a fractionalized owner and part of the governance of something that the main shareholders own 90% of.
Oh, for sure, right. And again, I guess it depends. The difficulty here with DAOs, and don't get me wrong, I don't think this is a counter argument, but more to sustain that point, I absolutely fundamentally agree with you. The problem you have with DAOs is they have no legal
Anchor.
Yeah, thank you. Yeah. I was going to say my brain went a bit blank, but yeah, they we've got partnerships, we've got companies, and a DAO, we don't have a legal entity or an understanding of what a DAO is. So then, typically, if we go back to regs or even from a tax perspective, okay, well, how do you safeguard that DAO? You stick it in a company. But as you say, that company has ownership. So you do absolutely have governance of what something is doing within a body that, sadly, because of the way that, I've said this word too many times, so I apologize. But again, the infrastructure to enable that from a risk perspective then leads itself away from actually what the DAO was designed to do. So I completely understand and agree with your point there, which is just a shame because conceptually what it stands for, I'm a big fan of. In the same way, and that's the same rationale as why I quite like the tokenized equity, right? Like it's the same principle here, allowing participation within something, but in a more understood legal structure than what we currently have.
I wonder if you could just basically take like 10% of your company and then you could sell a tokenized shares to a community, and then therefore you have an entire community promoting your business for you, and they're invested in that business doing well, and you being upfront about the fact is, hey, look, we own the other 90% of the business, but instead of it would be kind of like almost doing a decentralized. Well, I mean, it would be like doing an ICO, but not doing a proper ICO. You don't have to create a token for it.
No, yeah, well, absolutely, that's true.
You would have to kind of.
I was going to say it's sort of like having a B share. So you've got your A shares, you've got your B shares, or whatever share class that might be that you are fractionalizing. But I mean, that aside, like let's say I'm completely new to this. I then set up a company and I want to fractionalize. Sorry, keep saying fractionalize, but tokenize all the shares in my company. But there's some real risks there, right? If 90% of my shares are purchased by China, then I've probably got some corporate, residency issues in terms of 90%.
And some questions to answer as well.
yeah. I mean, not the best choice of country that I can probably get a fix. Sorry, China. But yeah, right. Have I now got a corporate residency risk in China? Because actually, if all these people are voting on things in China, then am I then subject to tax in China? Do I have to apportion my profits? Like there's the way that we've obviously got this global tax system and where we deem corporates to be resident from a tax perspective is incredibly complex, but so much of it does also come down to this concept of centrally managed and controlled. And actually, to then have to almost keep an eye on where your voters may be globally is opening yourself up to a great deal of risk.
But you could attach, say you want to tokenize just 10% of your company's value. And then you create the ordinary bees, and then you attach the ordinary bees to, you anchor the.
Absolutely. Yeah.
Let's do it.
Yeah, I just like it. Yeah, why wouldn't you? I mean, in the same way that people buy shares now in whatever projects they either have an emotional attachment to or want to make money from. Why can't or shouldn't we be able to do that in a token way? But it is fascinating, and I do think we will see, again, RWAs are still at most conferences. They're still it's an item
It's
that
very
is
hot.
continually talked about. Yeah, of course, for good reason. And I do think we will see more of that in the next few years. Right, we've got to. I still think uptake has been slow to some extent, or at least it feels that way. But then that's probably also aligned with sort of general adoption.
Yeah, I think so. I don't think there has been a sufficient number of successful projects yet to show RWAs in the dimensions of possibility and stuff. But then it also comes back down to, like regulation and compliance, right? So with RWA, for example, at the moment we're building a platform for a company that wants to link physical art to NFTs. So every time you buy the NFT, you're essentially getting shipped the art as well.
Yeah, nice.
And the NFT is essentially the proof of the authenticity and stuff. How do you manage that on an international tax level? If you say the artwork is sitting in, say, the UK and it's getting shipped to Singapore or it's getting shipped to Thailand, how do you create that economy and that kind of like that compliance or regulatory anchor that people can work with? And that's where it's like the whole world needs to move forward. It's not just certain
I know,
countries.
absolutely. Yeah, absolutely. I mean, we had this back, 3 years ago, 4 years ago with NFTs in terms of, again, sorry, sadly, being a tax person, right? Is there VAT on NFTs? Well, actually, fundamentally, yes, because you probably need to look through what the NFT is to understand what the underlying asset is and whether there's VAT. Right, okay, but cool. I've just sold 10,000 globally. How do I even piece that information together? And right, okay.
But you don't have to, because the VAT would only apply to the people who bought in the UK.
No, because no. So obviously VAT is European. So European concept, right? So we still have
We don't pay VAT
on
in the
digital
UK,
services. We have
Not on
VAT in the UK.
Not on digital services to EU.
Oh, I see. Sorry. Right. So it depends, but it depends what is underlying that NFT, right? It's the same concept. If my NFT was like a car and I'm basically selling you a car, we need to look through that to understand what the goods and services are related to that, whether that is digital artwork, whether that is whether it comes under digital services,
I always thought if like the point of service creation, or if something is serviced, it's the country in which it's serviced that the VAT is due.
So it depends whether it's B2B or B2C. So obviously we've got to business sales, we've got to customer sales. A lot now is done under the reverse charge in the EU, certainly when it comes to services. But all of these concepts of where people are that we cannot identify, but you are making, as you said, like going back to sort of, the global basis of this. Yeah, we need that infrastructure to understand where people are, maybe what even the tax implications might be for them or for us, if we are then crossing into country. I think there's still, I'm no US GST expert, but obviously there's thresholds there, I believe, before you have to start considering GST when selling to the US. So how do you then gather the quantum of information when you've effectively, you're suddenly an Amazon who's selling to like hundreds of different, thousands of different customers globally, but without perhaps sometimes all the necessary details about that individual and what those tax implications may be? Like it's huge. And the ability to scale to that size and have that participation, again, is not something that we've really seen to date, I would say.
The one question that we discussed earlier was, in the initial call, you talked about smart contracts and how it interfaced with accounting systems and things like that. What are your thoughts on how these are two quite different principles, because one has a lot of flexibility and one is very anchored to regulation per country and things like this? How do you see those two converging?
So I think, and to make sure that I've answered the question correctly as well, I like, when we go back to immutability and transparency, I quite like the concept from an efficiency perspective of being able to, wouldn't it be so much easier if I could go to a client and I could go, hey, look, can I have all the stuff that I need to make sure your finances are in order or something else? I mean, to be fair, I might not need to, because potentially a smart contract could do that. But you've got layers, and I don't know whether that needs to be completely transparent or actually, you've got a hybrid model here where there's some privacy and some transparency in terms of what we're doing. But the idea here generally just of immutable financial transactions that are interacting with smart contracts and various sorts of things that are happening. I really like that because even we were talking about it earlier on in terms of AI coming along and categorizing and reconciling and all of these sort of things, where if things could be on chain and they could be immediately tagged and categorized and accounted for in real time, you could genuinely have real time financial information. That's what I'm quite excited for, because if you've got that and then you could run smarter contracts based on that in terms of real time, real insights into things that matter, like run rate, like budget caps enforced by code, like automatic revenue sharing, like all of these other things that can be based on, and would have to be based on, and this is the big concern, right? Quality data within that, then the efficiency of a financial process and what that could mean for a business, like let's just say 100x, something like that, right? There's so much value within a system like that. The difficulties being that, one, obviously, smart contracts are only going to be as good as they are to be built on, and how do you audit that? I do strongly believe, or I did believe, probably about 5 or 10 years ago, we might be in a different place by now. But the idea being, like, the auditor now that comes in and wants to look through your bank statements and look at that, actually auditors are more developers, right? They're coders. They've written the smart contracts that will interrogate financial information, and actually, because it's all of there and it's visible and accessible, it can all just be done by code. And to me, that's really exciting, because it is to the accounting world what we've been talking about in terms of AI, right? The ability, like machine learning, or the understanding, these large language models that can read things. But this is actually talking about, no, we've hard coded financial transactions. You can't go in and change them. I would say in some ways, wouldn't that be great if almost that could then interact with the tax authority immediately? So you don't even have to worry about so many levels of compliance. Don't get me wrong, there's a very dystopian view about that, which we probably do not have time to go into, right? But the conceptually streamline so many of those processes through this has got to be best for all. But you'd have to build bridges between code and compliance. Otherwise, all you're going to be doing is replacing something which is fundamentally now quite slow and manual with something that's just fast and wrong, right? So there's a lot of things that would need to be considered before something like this would function properly. But the accounting utopian financial future that this could represent, I think, is quite a wonderful concept.
I'm trying to decide whether I agree with you, and I
No,
I partially kind of agree with some of the stuff that you're saying. I don't necessarily disagree with some of from the agreement side, like the concept that you could have a situation where you have like this real-time auditing capability on a mutable ledger. It could reduce the amount of time and the amount of issues that so many companies have and stuff like that. But inevitably that will put some companies out of a job.
Essentially.
But on the other side, the way taxation works, in the way you report, you communicate, how you take advantage of certain things, it may be like you're reporting something as R&D tax credit, or whatever it may be. I'm trying my best not to say something that is going to get me in trouble here. But the complexity of taking that power away from the business to do it in non-real time, there's an impracticality to that, I guess, based on the current system.
So, and I get that, and whilst I got too excited about the many things I was talking about, I left out the key part here, which is still judgment, and that's what you've alluded to right here in terms of the available tax breaks, the available considerations that I might choose to pursue in one way. What that takes out is, I want to pursue Y path and be open to a challenge later on down the line, because that's the way the current system works, as opposed to literal 100% compliance and towing the line by whatever a tax authority might deem those rules to be. That's the kind of dystopian aspect of all of this, right? I think from my perspective, I like the idea that if things were immutable and you would like, hey, Ben, look, I'm going to give you access now, the data is there for me to be able to go, right, actually, do you know what? I've actually got some script that assesses the eligibility here for the R&D claim based on various tags or various other things within the data, right? Going back to what you were talking about Excel earlier, like I loved I said, oh God, I almost said I loved when I became an accountant. And I'll stand by that, okay, as however sad that might sound. But suddenly there was like, hey, here's Excel. And I was like, oh, cool. Oh, Excel's got like Visual Basic on it. Never realized that. And all those
Yeah.
years that I actually spent inside a computer lab at school learning like Visual Basic, suddenly I was like, oh, right, I can use this in my job. And suddenly I had a load of data in Excel, and you're thinking, actually, the best way of combing through that data is actually to write something here that's going to do this all for me, because like there's hours I can save by just writing the code here to fundamentally analyze some of this for me. To the extent I actually had a client that got really cross because I was supposed to spend a week doing their accounts, and I think I did them in something like 2 days. And obviously I can't have done the job properly because everyone else before me had done it in a week. And I only did it in 2 days. So I basically had to almost go back and sit on site with the client just to keep them happy. But the time saving came from writing something that did the manual part for me, right? Like, come on, this isn't a new theme anywhere in the world. So if someone were to give me access to immutable financial information that had relevant tags and relevant other things, the concept of then being able to write third party, whether that's myself or code or whatever else, to go and analyze that data, you might even find that is more efficient than being with a current advisor, right? Like, so right now, let's say a good tax advisor, a good accountant will go, right, we've looked at your stuff. Have you thought about R&D? Have you thought about, I don't know whether it's applicable, let's say like the flat rate VAT scheme. Have you thought about, there's so many things for businesses to consider. And people that employ advisors are then going to be bound by their ability to be cognizant of all of the things that might apply to that business. And that's going to distinguish whether they are a good accountant or whether they are a good tax advisor, right? But if you've got objective data and programs that can effectively analyze that objective data to do much of that for you, then you'll know you're going to come out with specific outputs based on what you've put in, and not be reliant on whether I've had a full night's sleep last night, and how wary I might be when it comes to looking at something that you're doing. You are certainly, it's a double-edged sword. Whilst it lacks human judgment in the ability to make your own decisions for, let's say, for tax purposes or something else, it also removes certain judgment that advisors or accountants might use that data for, which almost makes it more efficient for the end user, because you're relying on the existing frameworks being built into code and analyzing that data to give you an understanding of that output yourself.
When you're talking about these type of things, that I don't think that there is one simple, uncomplicated answer to it, because there's so many variables that have to be considered. And like, are we talking about the UK? Are we talking about Cyprus? Are we talking about Singapore? Are we talking about America? Are we talking about stablecoin? Are we talking about non-stablecoin crypto assets? Are we talking about blockchain industry? There's so many variables in this stuff that, and in every single variable you change, the rules change. And so, like, yeah, I don't expect any answer for you to have given today to be simple. But we're going to move to simple questions now.
Okay, cool.
If you could change one major tax policy to support blockchain and blockchain innovation in the UK, what would it be and why?
Can I have two answers to this question? One would be removing some of the pain points. So there was a consultation on DeFi ages ago, which basically looked to remove every single time, like I don't know, let's say I collateralize an asset, for that not to be a disposal, right? We've got too many tax points that give rise to a dry tax charge. So you might not have taken any money out of crypto entirely in the year. You've just been swapping, you've been taking positions, you've been earning, but I come along and I go, cool, you've got £30,000 to pay, right? We don't really have it in any other, again, going back to that barter, we don't have any other form of asset where that kind of really happens to that extent. You know, typically if the whole system is geared up to, you sell an asset, you've got the money, you pay your tax. So some sort of equalization there with other asset classes to make it a bit fairer on the taxpayers and what they're looking to achieve. In France, right? France don't tax crypto to crypto transactions. They just tax it when you actually off-ramp it into fiat. Seems very far more simpler for the taxpayer.
Very similar in Estonia as well, I believe.
Yeah. And the other thing I would do would be to also create a special purpose vehicle, like an ISA, right? You've got ISAs for stocks and shares. You've got these tax efficient wrappers to undertake an activity in, up to a certain extent, sure. But I think if you had that for crypto, one, people could get in, understand it a bit better, invest like they can in various other asset class in a tax efficient way, and I think that would help drive adoption, because suddenly we're going, hey, look, there's something that looks like something you already know, but you can go and do it in this asset class. You don't have to worry about tax for the first like 20K or something like that, right? Yeah, that sounds quite appealing to me. That allows people to sort of go in and all those hobbyists or whatever else. A lot of people would drop out of non-compliance because obviously the annual exemption rate is now £3,000. If you make more than £3,000 in crypto, you have to do a tax return. Like that's bonkers.
I thought it was £10,000.
So it used to be £12,300, and then it dropped to £6,000. Now it's dropped to £3,000. And for crypto, that's quite significant, right?
I mean, £3,000 is like the value of Ethereum.
Yeah, I know. So the compliance burden then for people in this space is just increased. So I think just give them something where they can go, right, we can have a play, make £20,000 of gains, and we're happy with that, and it's not taxable. And then obviously, if you become a millionaire, there's taxes to pay, but otherwise let's drive adoption by making it a bit more tax friendly.
Fair, good answer. I have retainer comments, but I'm not going to answer them. Ask them. Okay, so given how much we've spent talking about like the lack of speed when it comes to like regulation and compliance and stuff in this space, with multiple markets as well. If a CFO was sitting here listening to this and he's working in his company, why would he consider engaging with blockchain?
I guess it completely depends on the industry, right? I love, again, when we talk about technology and efficiency and data, the thing that always springs to mind is traceability or efficiency for me. It's the Walmart case, where was it 2 mangoes, I think they traced back to the farm. Love that story. Just the ability to actually have that immutable data from farm to supermarket for the purposes of, being able to go, oh, right, actually there's been food poisoning from certain chickens we bought from Iowa. God knows, sorry, hopefully Iowa don't have a chicken problem. But anyway, right, but the ability to then move on that data far quicker because you've got everything in place. So one is obviously the blockchain technology aspects of, right, okay, how might your business better use blockchain technology for something that it does? You've seen that in the industries like Walmart or in the coffee industry in terms of responsible sourcing of coffee beans and transfer, and certainly with medical records, like I get so frustrated that I think I forgot to tax my car, or they didn't send me the form, and then I've got to take a bit of paper down to the post office, and like, God, this is something from like the 1970s. It feels, right, guys? Like, why can't everything just be on chain? I can go to the post office, I can scan an NFC chip or something, right? There's got to be better ways to maybe look at how you're using data and why blockchain might have an impact within that. But then the simple side for me is actually just the self-sovereignty. Like you've mentioned stablecoins there, right? The ability to globally transfer value and your ability to be in control of that.
Without using Swift.
Exactly. Fees, speed. I don't know if it's still true. I remember 5 years or so ago when I was doing podcasts, it was quicker to send an anvil to China than it was to send money there because of obviously all the different like institutions and KYC and all the things that you have to go through. And that seems bonkers. So I think for anyone looking at other means or even reaching other markets, interestingly, we had a query the other day from it was a super yacht business that are looking at accepting stablecoins, I think to obviously try and enter a different form of the market, as well as using that for global payments. I did mention that we only take payment in stablecoins. Oh, I effed up that joke. Super yachts. I only wanted a super yacht for payment, but that joke is completely redundant. And hopefully I didn't say stablecoins and you think I'm an absolute idiot, as I now feel. But
I have a few super yacht people if you need help with
right, okay. Okay, thank you. Yeah.
Weirdly enough, I have 3. Despite
nice.
the fact that no one's ever invited me on one, but
friends. No, great. But it is that idea, right, of just being able to be in control of value and being able to do that yourself, which I appreciate for many CFOs out there that may not be comfortable with this space. Quite terrifying, but actually I think the opportunities that obviously then exist by being able to do so can only bring efficiencies to those businesses.
Like I still think we're in early iterations of blockchain, and you don't start from perfect. You have to build those iterations within your business to make sure that you are utilizing the technology. There's obviously opportunity with the technology, but if you don't build with it and you don't start to create that kind of knowledge center in your business, then you're never going to get the advantage of it. And then you'll wake up one day in 5 years' time and you'll find that, everyone around you, your other businesses, even your colleagues have overtaken you, and you're just sitting there with something in your hands.
Yeah. Yeah. And I think literally just carrying on from your point there is quite interesting, because blockchain used to be such the buzzword, right? And obviously AI now is a much more exciting term that people throw around. And I think what people are then perhaps forgetting is the use of blockchain technology, but also the use of it with AI, right? Where you might be using AI to form a solution, and actually there might be an alternative way of doing something with blockchain, depending on what model you're using or whatever else, right? But for blockchain to act as the immutable ledger to whatever your AI model might be undertaking. So yeah, it's certainly that blend of the technologies that are out there and making sure that you're growing with them, whatever they may be and how they might have a purpose within your business.
All right. So I'm going to ask the very simple last question. If people are interested in getting to know more about your company, Andersen, or yourself,
Sure. Yep.
Ben Lee, what's the best way to get in touch? Where should they go? How should they get in contact?
Yeah, sure. By all means, give us a Google. I'm quite active on LinkedIn. And don't get me wrong, I use all the platforms, right? We've got Telegram, Signal, we use everything, but I am quite present on LinkedIn. If you literally Google LinkedIn and crypto tax, Ben, sorry, yes, it's cheesy and cliche, but that is my sort of specific URL on LinkedIn. So you'll find me. So by all means, pop me a message, get in touch. Always happy to have a chat with people.
So you don't want them going to Andersen then?
There's lots of information online, on our website in terms of case studies and actually quite a lot of good, useful information for individuals and businesses, and on international structuring and everything. So by all means, there's a lot of information that we've put out there in that space. But if you want to have a chat, then yeah, feel free to get in touch with me.
Thanks for joining us on Blockchain Beyond the Hype, exploring how to harness blockchain technology to transform the way we do business. If you enjoyed today's episode, then please subscribe, leave a review, and share with other people who are passionate about creating change. Until next time, keep innovating and pushing the boundaries of what's possible.